All right.
Hi, everyone. Thank you for coming in and spending some of your time out of your day to learn about 1031 exchange here with us. We're excited to have you.
All right. Well, thank you. So let's see here. Welcome to another exciting session of our Doors, Deals, and Dollars. My name is Tiffany Lunt, and I'm the Director of Syndication at Freeman Lunt. I'm thrilled to be joined by my partner here, Carla Cordovis, Managing Director at Gold Moon Capital. Together, we are the team behind Doors, Deals, and Dollars. So, as Carla mentioned, we're going to be diving into the powerful topic of 1031 exchange and how savvy investors are strategically using this tool to scale and optimize their multifamily portfolios. So, just a quick intro about myself. I come from nearly 2 decades in commercial banking and lending. And so now I'm very passionate about helping investors build wealth through multifamily syndications, one smart deal at a time. So, with that, I'll turn it over to my partner, Carla, to share a little bit about herself.
Hi, everyone. I'm Carla Cordovis, and I've been dedicating myself to real estate for a few years now through long-term and short-term rentals and acquisitions, and almost a year ago through multifamily investments. I have acquired now 96 units and looking to close on my next one in a couple of weeks. My background is in technology, auditing, and quality management. I speak 3 languages professionally, and these languages actually have opened my professional world into more ways that I can count. Since I have traveled and lived in so many different cities throughout my life, I believe that gives me an awesome and amazing starting point to manage properties and getting investors towards lucrative opportunities in our chosen markets. So I'm very, very excited that today we're speaking about 1031 exchange because it's a big one for what we do here. Now, before we jump into today's content, just a quick reminder, this is meant to be an interactive session. We welcome any and all questions, so feel free to either raise your hand or drop your questions into the chat at any time. We'll make sure to address them at the most opportune moments throughout the webinar. And without further ado, it's my pleasure to give a very warm welcome to our guest speakers, Marc Gould and Tommy Hinson, who I think will be joining us in a few minutes from Investors 1031 Exchange. Tommy,
Yes.
yeah.
Tommy. So Tommy got stuck. He's in meetings right now. He might jump in just on my screen, but I'll give it a little introduction. My name is Marc Gould. I run Investors 1031 Exchange. The company was started in 2008. Tommy's the CEO. He started it then, and we've been a really successful qualified intermediary since then. Our experiences, Tommy was a developer. He also had an escrow company. Continued to do development and has been in the business for a really long time. I was a developer. I started a development company about 15 years ago. Just kind of took it down. I was able to build 3 different high-rise apartment buildings, did it myself with my company, and then entitled about 8 other properties, sold those to developers, and then sold off 2 of the buildings, then sold that company and been trading properties ever since. A couple of years ago, Tommy and I were friends, and he's asked me to come run this company for him. So our experience is kind of vast through, being investors, and since being a 1031 company, because we are an independent national company. So instead of being bound by corporate laws, by being tied to title or escrow companies, we're able to help our clients strategize and be a resource and assist with brokers and investors to kind of build portfolios of what they have and future growth for all investments. So would you like me to, should I open the?
Yeah, go ahead. I'm going to
All right, so share screen, and let me just do this. So you share it screens. Okay. So I'm always kind of new to this technological stuff.
And each software has a different
I
feature,
know.
a different place, so you never really know.
Right. So I'm going to bring this over here.
Good to see you, Shirley, Mike, Roger,
Yep.
Mitchell.
Screen share. Okay, so you see that, correct?
Yes,
see
we're
the
seeing the.
presenters
What do you
view.
see? You see the presentation?
We're viewing your view instead of the front end view.
So you see everything, huh?
Yeah.
Okay, let's see. How do I stop sharing? Let me do that
I
again.
swap displays on the top left. There should
Yep,
be somewhere that says swap displays.
yep, got it. Got it. Boom.
Yep, there you go.
All
Excellent.
right. So, so just kind of walking through this, and this is we kind of get into the nitty gritty of this, but it kind of starts with you know, open slides, brokers, investors, kind of increase your deal flow. So there's a whole ecosystem within a 1031 exchange. So whether you're an investor or a broker, there's a lot of things within exchanges that you can also leverage and able to kind of build your portfolio from one property to two to three to four. So we kind of came from the idea that, you know, what I already mentioned is, you know, because we're independent, we're able to help strategize with clients and become part of the team with agents and brokers to kind of team up with them so that they can also assist with their clients so that we can become a team for years to come for all the properties we do. So this is just a funny little quote that I made up. That's why it says an absolute actual client. That is supposed to get a chuckle out of everyone that's in the room. But basically, let's get to the next thing. So what this really starts with is for investors and agents to kind of understand what happens is, let's say you own a property. And so, you know, providing new value through capital stacks. So you own a property, you bought a property for $1 million and you put $200,000 down and you had an $800,000 debt. And then, you know, fast forward 10, 15 years, you're still paying on that $800,000 loan, but now your property's worth $2 million. And so ultimately, you're paid down and you only have $300,000 debt left, but you're still paying the same mortgage rate that you had on $800,000. And you're probably most likely under market rate rents. And so the idea is to really assess the value of your NOI comparative to the equity and the market share that you have within your property. And this is just kind of an overview, you know, case study that's, you know, it's not so much that you can buy an extra you know, door for $100,000, but the idea is, okay, well, let's go ahead and sell this and then go buy a property for, you know, $2 million. Because when you do an exchange, you have to sell $2 million, you have to purchase for 2 million or greater. So then you sell for 2 million and maybe you get a property for 2.1, but it's newer construction. Then you can up the rents. It maybe doesn't have, you know, leasing's not there yet, or it is, but then you can come in and transition those renters. So then ultimately you're paying on 800,000 before on 300, but then you go and buy for 2.1 and then you get a $400,000 loan. So you're decreasing your debt payments, but then you're stepping up to market rate rents. So now you're increasing your income. And so it's kind of the understanding that you can do that, or you can sell for 2 million and you can buy two properties for $1 million each, or three or four, just depending. But ultimately what happens is that the goal is to, through 1031 exchanges, eventually becoming debt free and just buying things with the equity. So you're just increasing your income and lowering your debt payments. So for us, you know, we created a few different systems to help investors and brokers, where if you're going to sell this property, since we've been in this business since 2008, and just to speak to this, is this kind of shows, I'll get back to that in that last sentence, but if you sell properties and you want to just pocket the money, you have to pay taxes, right? But through this is that you are able to create a bigger return on your investments and continue to do that. So now what happens is that since we've built this company since 2008, we've happened to have about 24,000 contacts from our past clients, our current clients, our network. And because we're independent, we can actually help resource that for our current clients. So we created a deal room within our website that every week for years we sent out marketing emails on Wednesdays to all of our contacts. And it kind of wasn't being such a resource. And so 2 years ago, we set up the deal room. So any client that says, hey, I want to do an exchange, the brokers and we all work together. And so we then upload that deal that's going to sell to our deal room. And then every Wednesday, that deal room gets blasted out with each deal that's presented as the deal of the week, and send it out to 23,000 people, because we know that in this business, brokers and agents pay a lot of money for marketing and leads, and then clients are leaning on the resource of what those agents have as marketing. And so we wanted to create a system that helps this move faster, that gets it to active investors. And this contact list is all active investors. So it's an amazing system that we created to help sell these deals. And then once the deals sell, then they come through our exchange, and then they also need an upleg. They need to find a property or a TIC investment, like a tenant in common investment or a DST. And so we talk with the broker and the client and find out what they want to do next. And then because we have an exchange, people are in our exchange that have cash that they need to spend in 6 months. So everyone sends me every deal. So then I get these deals and someone tells me what they want. Then I just send it to the broker and they will pitch the investor on that. And then it just kind of completely makes a full circle on the help. And for us, none of it costs anything to anyone. Obviously, our exchange, our range, we range between $595 to $795 per exchange, and that's it. And then $195 for the upleg. But to use the system, like the deal room and the outreach and the help from us to find the next upleg, it doesn't cost anything, because in my mindset is that I can't run an exchange unless deals sell. So I need to use my network to help do that. But then I also don't want my clients to default and not find the next property or the next investment to invest in. So then I help them find something, because I don't want them to not succeed. So this is the deal room, and I'll get emails from everyone after this, and you don't need to screenshot this, because I'll give you a PDF of the entire presentation, plus a couple FAQ pages and things that might need to answer. But so now let me just talk you through exactly quickly what 1031 exchange is referred to. So it's section 1031 of the IRC tax code. And this just allows any investor that's bought an investment property to be able to sell that investment property and then purchase an investment property by deferring their taxes. And you defer your taxes, so you don't cancel your taxes out. But one of the things we always talk to our clients about is we want to find out if it's in a trust or not, because ultimately there's that saying where swap until you drop, which means that if you have your properties in the trust, then when you do your exchanges, you're deferring all these taxes, deferring. But then when you die, the beneficiaries of your trust take on these properties, but every deferred tax that you accrued the entire time that you had your properties now deletes when you pass away. And then the only thing that happens, which is also a benefit, is there's a step up of tax basis. Now, that means that if you have a $10 million portfolio, but the tax basis on that $10 million portfolio is $7 million, but then you pass away, all the taxes that you deferred are gone, but now it steps up to 10 million, which means your beneficiaries could sell that portfolio for $10 million and not pay $1 in taxes, because that is the new tax basis from that, from you, unfortunately passing away. So a couple rules about the 1031 exchange. You have 180 days, so 6 months. The day you close, your time clock starts. So you have to complete your exchange in that time. Then within that time is the 45-day identification period. Now, 45 days is kind of a silly rule, and that's not anything that the government really looks at. But we always tell our clients, hey, we'll start helping you look for a couple, upleg projects or properties before you even close, so that you can put that timeline in. Now, what I'll tell you is that sometimes people get really scared of that number, but there are ways for us to work around the 45 days, because ultimately what has to happen is that you find a property and you buy it, and then that's it. As long as you don't extend the 180 days and you purchase a property that's an investment property and you sold one, then the government just says thank you and passes you on. And by any chance, if you guys have questions, I don't have the chat box open, so if anyone sees anything and you put in the chat box, someone just blurt it out. I just interrupt me. I have no problem, because I'd love to answer any questions as we move along. So yeah, let's make it a conversation rather than just a presentation. So then the way that exchanges work is there's forward exchanges, there's reverse exchanges, and build to suit improvement exchanges. So forward exchange is pretty basic. I'm going to sell my property. It's going to go into the exchange, and then I'm going to then purchase the property. And then a reverse exchange, it becomes a little more complicated, because you have to get in touch with me early on, because ultimately you cannot purchase a property from yourself. So we have to set up an EAT, an LLC that purchases the property under us. So you become the manager of that EAT, but we are the members. And then that EAT then does a triple net lease back to you while you hold that property. That makes you liable for that property, but that has to be purchased not from your name. And then while you sell your property that needs to be sold, then that sells, and then that goes and turns into a forward exchange. That sells, goes into exchange, and then that exchange, the money that comes from that sale, then purchases that property and pays off the debt that you had to purchase it on, like that. Or or you didn't have to get debt and you had the cash to do it. And then we remove ourselves from that LLC, and then you become the member, and you can keep the LLC or you can get rid of it. And then that's a reverse exchange. So you're basically purchasing a property first and then selling yours after. Build to suit is very similar, where it's a forward exchange, but if you purchase a property, if you sold your property for $1 million and you find a property that's 800,000, but you need some work. So you'll then go and you will sell your property for $1 million, but we have to set up the EAT again, because we have to be able to purchase that property in the EAT where we're the members, and then the 200,000. So you'll sell yours for $1 million, and it'll go into the exchange. And then you find your property, and then we have to set up the EAT again, purchase that property, and then you'll do the $200,000 will stay in the exchange, and then you'll do your, fix the kitchen, or if it's a single residence or something that needs work, and then it'll draw with invoices will get sent to the exchange, and then that will then pay from that $200,000 to fix that property to fulfill the exchange. Now that has to all be done within 6 months. So it's for improvements. It's not for, development essentially. And then, we've had a few times where they're at like 165 days and they still have 25,000 left and they still have a couple extra things. So then we say, well, do you trust your contractor? Because then ultimately you'll need an invoice for 25,000 or, whatever, $35,000 if they've spent 165. And then they'll then send that invoice in, even though the money's not done, then that will get paid out, and then it'll finish it before the 180 days, because whatever is still in there at 180 days gets cut. And then if that $35,000 is still in there, then you'll get sent back that money, but you'll have to pay your taxes on whatever's left. So you'll pay your capital gain taxes on the $35,000. So, depending on what state it's in, it can range from anywhere from, with depreciation recapture, you're looking at, anywhere from, 28, 30% to 45% with all that stuff. So then, is this not moving? Give me 1 second. Hello. Sorry, guys. Pause. Here we go.
Yeah, there you go.
Yeah, perfect. So qualified use requirements. So basically, it just comes down to investment properties. So rental income, investment, use in business. Those are the things that you can invest in. So you can, anything that's an investment in property. But if you want to acquire a property to fix up like a flip and then sell in 6 months, then it won't qualify for a 1031 exchange. And I'll get into intent in a few minutes. Or condo conversions or property acquired to develop. Now, you can 1031 exchange into land and then develop a property that you intend to develop and rent out and hold. Now that can totally be fine. And that is based on intent. This entire law is a law that is based on your intent. So the time that most people know can be cleared is like if you hold it for 2 tax cycles. So if you can get through 16 months and then you need to sell, as long as your intent was to hold this as a rental property or an investment property and hold it for a long period of time, but something happened that you needed to sell, then you can do that. After 16 months, and you have 2 tax cycles, it barely gets pinged. But if you have emails going back and forth and text messages saying, this is investment property, I can't wait, I'm going to set it up and I need to rent this property for a long period of time. But after you've held it for 2 months, someone knocks on your door and says, hey, I want to purchase this property for $4 million and it's only worth $2 million. Well, now your intent just changed because someone's going to give you $2 million more and then you sell it. And then if you sit across from the auditor, they're going to ask you, hey, you sold this in 4 months. And you said, yeah, well, my intent was to hold it for 5 years or 10 years or 20 years, but someone just knocked on my door and said, hey, I'll give you $2 million more for this property. Well, my intent changed. And they'll check your emails and text messages and so on and so forth. And as long as what your intent was true, then you're good. But it all bases down to intent. And that's why they say 2 years, because after you make it through 2 tax cycles, it rarely gets looked at as long as you are collecting income or you have investment purpose behind it. But it does just really base off of intent. Or, hey, something happened in my family and I had to sell, or, the market went upside down and I'm broke and I need to sell it. So as long as the intent behind it was pure to be an investment property and not just flip out of it, then you're good to go. So the intent to reinvest in like-kind property, and we'll get to like-kind in a second, the investor must trade equal or greater fair market value based on the net sale price. So when we talk about net sale price, if I sell my property for $2 million, I'm going to pay my $695 exchange fee. I'm going to pay escrow, I'm going to pay title, and I'm also going to pay commissions. So at the end of it, I'll walk with 1.875. That is your net proceeds to be able to that's what you sold for technically, minus the those fees. Now, if you have $400,000 in loans, so you have 1.875 that you technically sold for, but then you paid off your debt. Now you have 1.475. You still have to purchase for 1.875 because that's your net proceeds of selling that property at. And so that's you have to replace debt replacement. Now, it doesn't have to be debt. If you have $400,000 in cash, you can add cash to meet that price, but some people don't. And so it's usually called debt replacement. But a lot of people ask, like, do I have to go get debt called debt replacement? No, you just have to meet the number. And you have to invest 100% of what you earned on it. So at 1.475, you have to put all that money in and go get either more cash or debt to meet your 1.875. Now, what people do come to me and they say, well, look, I want to pull a couple $100,000 from my proceeds so I can pay off some credit card debt and I want to take my family on a trip and go on some vacations. And I say, that's great. The best scenario with that is, and people don't think about this, is look, you sold for 1.875, go buy for 1.9 million, right? And go get your $25,000 loan on this. And now you've increased your market rents and you're pulling in more money. And then you have $25,000 loan on this property that's like, maybe what, 5% loan to value. So then if you need money, then go cash out refi against that. And because debt is tax free, so take on that equity. So ultimately bury your money in the property and then take the debt against it to get the cash to pay off those other loans and take your family on vacation, because then you're sitting on a property that's, well, I'm sorry, I said 5%, but that was a misspoke because it's 425. So ultimately you're still under 50% loan to value. So go get $200,000 more and you're still way under that, and they'll give it to you and you'll be able to pay off your stuff, whatever else you have going on. And then that way you don't have to deal with paying taxes on that. So like-kind property, people get stuck on this all the time. They go, Mark, I'm selling a rental home, but I want to buy an apartment building. Or I'm selling an apartment building, but I want to get like 4 rental homes. But that's like not like kind. I go, no. The problem is the government set it up to confuse you, but ultimately like-kind properties just means investment real estate. So if you sell a single family, you can buy a commercial office. If you sell retail, you can buy vacant land. If you sell, 30 plus leases that you hold, then you can buy into TIC DSTs or oil and gas interest or multifamily. So you can basically, any investment property is like-kind property. So not like-kind properties is primary residence. So primary residence, you can't exchange that. Now, you can if you do the 2 out of 5 year. What that means is, oh, there's a chat. What's the chat say?
Just me saying that it's a great information. The like-kind properties, it's always a confusing point for everyone. Everyone thinks that they cannot do 1031 exchange because they're going from single family to multifamily or whatever the case may be. That's good information you just give there.
So like-kind means investment. That's all it means. So you can sell land and buy a commercial building. So yeah, as long as it's investment. So not like-kind properties. Now, primary residence, I need to redo this slide a little bit because I'll get back to that one in a second, but ultimately a property held for sale. So I can't just buy something that I'm going to resell. Again, back to intent. I can't take cash. I get burned on that with taxes, stocks and bonds, mutual funds and REITs. Now, you can up REITs. So you can exchange your money out of the sale of your investment property into a REIT. A REIT is a share in an LLC or corporate that then owns a big property. But a REIT, you then up REIT into that investment, but you can't get out of it without paying taxes, because once it's in a REIT, if you want to sell your REIT shares, then it goes back to stocks and bonds or shares in a corporation. So then you can defer your taxes and go into a REIT, but then you cannot get out of the REIT. Ultimately, you have to stay in those REITs forever. Because if you want to sell your REITs, you are technically selling shares. Partnership interests, meaning if I'm selling my property, but I want to go purchase a property, but I have partners that are in it, that we're going to gain it. We're going to create an LLC, and the same thing kind of ties in the next one, is that I have to, whatever I purchase next has to be the exact same tax identity that's sold. So if I'm in an LLC and I'm in an LLC that's myself, which is a pass-through entity, then I can purchase the next property under my name or my LLC because it's a pass-through entity. But if I have an LLC with a friend and we were partners and we want to sell, then whatever we purchase, the partnerships have to stay exactly the same and we have to purchase together, which is why I tell clients, if you want to go into partnerships, you create your own LLC, they create their own LLC, and then you purchase the properties together. That way you are tenant in common. And then that tenant in common, when you sell, let's say we sold for $1 million, then my part of that tenant in common is $500,000. So now I can do an exchange with my $500,000. And because I didn't sell for $1 million, I sold my $500,000. So my exchange is now only $500,000. But if my partner wants to do something else, they can do something else on their own without any hiccups in that system. So ultimately, the tax identity that holds the partnerships inside or the singular person inside a real estate transaction has to 1031 in the exact same singular or partnership that they are selling to purchase. So back to primary residence. Primary residence is a 2 out of 5 rule, meaning if I live in a primary residence and I'm like, dang, how do I purchase more properties? I'm going to move out of my property and rent it out for 2 tax cycles or 2 years. And then after I do that, then I can exchange, because in 5 years, I can have lived in my property or I can have rented my property all the way up to 2 years before I want to sell. Then I'll just move in for the last 2 years and I'll sell. But I can exchange it because out of the last 2 to 5 years, it has been rented. And that's an income property. And the best part about doing it like that is you get to also exchange. So if I had a $2 million property that I lived in, but I rented for 2 years out of the last 5 years, whether it's on the beginning or end of 5 years, I can exchange it, but I also can take the IRS 121 tax code, which is I can take $500,000. Well, if I'm married, I can take $500,000. But if I'm single, it's $250,000. So it's $250,000 per person, but it goes to only $500,000. So obviously, if we're married, we're with one other person. So ultimately, if I'm married, I can get $500,000 tax free. So that actually reduces my exchange. So if I sell for 2 million, then I'm going to, in the 2 out of 5 year, then I'm going to sell it. I'm going to take $500,000. So now my exchange is only 1.5. And so that's all I need to exchange. So I'm already taking the money, but then I'm exchanging the 1.5. And then that's the only number I need to reach. So it's kind of a really cool trick in how to do that. Now, this is speaking to California taxes, and this changes around the country. So I think, like for, I think I don't know every states, but I know like, 2.5 in Arizona. I think it's 2.7 and here it's a little bit, it's what, 15, or sorry, not 15, but it's 13.3 or 12% in California. But ultimately what happens is that this is how the taxes impact all of our real estate investments. And it kind of runs down through each one of these in California. Now, I have numbers on every state. So depending on the state, I can deliver that to anyone. But
Hey, Mark.
yes.
Yeah, sorry to interrupt. Todd Bailey here. I have a question. My wife and I own a three-family in our names directly, and we want to exchange it for a property in an LLC. I know you mentioned this is maybe not possible through a 1031. Is there a way to structure that?
So explain to me, you own this investment property in your names,
Right.
and there's a property existing that's held by an LLC.
Well, no, we want to buy it in an LLC. We don't have that other property yet.
So do you and your wife file jointly,
Yes,
and you want to set up an LLC, just you two alone?
that's correct.
Absolutely can do that because you file jointly, which means an LLC becomes a pass-through entity to you directly for tax liability. So if you are the tax liability, you are the taxpayer on the property, you and your wife file jointly. So you could, what I would suggest doing is purchasing it under your names, the way you sold, and then you can just set up your LLC and quitclaim deed it into the LLC. But you could also just create the LLC and then purchase it in that. And that's totally fine because ultimately it's still a pass-through entity and you are the only liable taxpayers on there. So it's the same thing. So because an LLC becomes that pass-through, then for you, that's not an issue. And we'll help you go through that. Stephanie, the woman who runs our exchange officers, was a escrow officer for 25 years, and this is like the back of her hand. So, we can, after this, she'll connect us all on emails, and I'll send you information and we can walk you through that. But you absolutely can do that. As long as there's no other
Outstanding.
partner.
As long as we're not adding a partner, then we're okay.
Absolutely.
All right,
100%.
thanks. Thanks,
Yeah,
Mark.
and you should do that. If you should put all of your properties in an LLC. And then on top of that, my suggestion would always be build a trust, and then the LLCs would own the properties under the trust. And then the other secret thing about that is then you build another LLC that is the property manager of those, and then that property management bills each LLC for the property management, and that money is paid out from those LLCs to the property management LLC. That way you get rid of the money coming, you can decrease the income coming in from each home, and then you can put that in even an S corp, maybe not an LLC, but an S corp property management, and then pay yourselves those as employees through the S corp under the trust. But ultimately, then it's doubly protected because it's under a trust. So then you really can't find or be sued and stuff like that. But we can talk about that on another one. But so yeah. Great, and I'll help you go through all this. But here's the case study, and depending on your state, it's going to differ, but I'll talk to you about California. So let's say that we purchase a property for 500K, right? We hold it, now it's worth $1 million. So your total capital gain is $500,000. Now, again, what I need to include in this is that if it's an income property, we take depreciation. And so if you want to think about what depreciation is, you take depreciation to offset income to not pay taxes. So I'll say I made $200,000 this year, but I'll take depreciation, and that'll say I depreciate to $25,000 this year, and that'll decrease my taxable rate to $175,000. So and what that does is it says total capital gain, but that needs to change. Is that every time I take depreciation, that actually pulls down my initial investment. So if I invested $500,000 into something, but now it's worth $1 million, but I took depreciation over the years, then that $500,000 I invested now also depreciates with the money I took not taxed on. And so that's why it goes, hey, federal tax, Medicare tax, California state tax. So my net capital gain is $329. But it actually is more than that because whatever it took from depreciation on this. So it says $185,000 that I depreciated. So technically it would drop that to $315,000 of my initial investment. So really it's $685,000. That is my capital gain. And then the government says, oh, well, you took depreciation. Well, you took $185,000 depreciation. So we want 25% back on that. Now the catch is this: if you don't take depreciation, the government does not care. If you didn't take depreciation, they will then say, well, you could have, and this is how long you've owned it. So this is what you could have depreciation. We still want our money back. So ultimately your net amount. So if I sold it and just took my cash, now I only have $283,000. Okay. So that's what I have left to reinvest. But if I was to do a 1031 exchange, well, if I took that, so now walking through case study. So without an exchange, I have $283,000. I'm going to go reinvest that into real estate. Well, I can only get 50% LTV. So my gross scheduled income per year is only 10%. That's $56,000. But if I utilize the 1031 exchange, kind of speaking to everything else, now I have $1 million. So I have, 500,000, and I'm going to switch this again because the numbers are wrong. But ultimately I have to put $500,000 in, and I'm going to get a 50% LTV to get $1 million. And now my scheduled income is $100,000. So the difference is $43,000 by utilizing the 1031 exchange. And ultimately that could go into 1 or 2 or 3 properties. But ultimately the goal with the 1031 exchange is to reduce the debt payments, increase income, and spread it. So I sell 1, I could buy 2. Then from there I can sell 1 of those 2 and buy 2 more. Now I have 3. Then I can sell 2 of those and buy 4. And so it's a way to be able to strategize to build a portfolio, and because of the swap until you drop, you thus ultimately build a generational portfolio that takes care of it. So on the other side of things, when people don't want to pay taxes and they're getting older and they say, well, I want to keep reinvesting in real estate, but I don't want to, I'm tired of the 3 T's, right? The toilets, tenants, and trash. But I want to own something, I want passive income. So then there's 2 different scenarios that you can still go into that can be exchanged out of again, and that's TIC and DSTs. So the TIC is a tenant in common, and the DST is Delaware Statute of Trust. We prefer tenant in commons, and there's the pros and cons. So ultimately, you become a co-ownership in real estate. So you have a couple investors that also buy into this, and you're buying into, like, let's say, a 100-unit apartment building with maybe 3 other TIC investors, but you have a undivided interest, meaning your name is on title, you have a deed to the property, and so then, your timelines can be as short as 2 years, because ultimately when you purchase in, as long as it's 2 years, you can sell for a 1031 exchange. And then the operators tend to buy you out, but they buy you out with if you bought into a property that's 10 mil and you own 10% of that, and then now all of a sudden it's 15 million, well, when you sell your piece, then you're making your profit share of what it is that a normal asset. A Delaware Statute of Trust is a trust that a syndicator owns, or a corporation kind of owns that trust to be able to bring in money to invest into big projects. Now with the TIC, it's usually 2 to 4 different investors. In a Delaware Statute of Trust, they can have 500 investors into the trust that allocates those funds for investment. When you go into a DST, it's usually 7 to 10 years locked in, and your rates of return are a lot lower, and your profit share on the outside is a lot lower as well. But some people like it, like as a retirement, where they don't have to deal with anything, but you really don't have to deal with anything in the TIC otherwise. But some people like those things. And so, we're unbiased. I'm always here to service our clients in the way that, hey, you want to find an upleg, I'll help you find it. Or if you want to get into Delaware DST, hey, send it my way, I'll take a look at it. And if that's where you want to go, I'll look over the numbers, be like, yeah, this looks great. Or tenant in common, yeah, this looks good. We have 2 operator syndications, as well as Tiffany, that has these projects that do that. And that's where I like to lead our clients into places that I trust, because we've been in this business long enough and we underwrite deals. And so every deal that I have a lot of clients that go into TICs right now because of the market. And we have 3 places that we can put those. We have Seattle, we have San Diego, and we have what Tiffany does. And so ultimately, that's where we trust, because they've been doing this for a long time. But if someone finds something, I'd love to see the numbers, because I can underwrite it and be like, okay, check this out, go talk to your CPA and get validation on what you like to do. But we like to focus on shorter timelines, meaning 3 to 5 years in a TIC that's going to do another exchange into another TIC deal, or you're going to make a huge profit. You can exchange that into now a new property that you want to own by yourself. So this kind of talks about reverse exchanges. We don't need to go too deep into this, but ultimately it kind of gives you a little bit more gradients of just details about what it is. Right now, we see a lot of people doing some reverse exchanges, but it has to do with the price point of what you're purchasing, because again, it's like $695 to do an exchange, forward exchange. A reverse is about $8,000. With other companies, they want to charge 12 grand, but ultimately those are attorney's fees, setting up the LLC, with the triple net stuff, and basically securing you and securing us through that. So this kind of gives it, and you're going to get all this information, so it's something for you to look through afterwards. So this is a step-by-step process. And then the build to suit is kind of this, basically details again. Seller carryback is, I've had people want to do seller carryback, right? So they say, well, we're going to sell this $20 million building, but they can only bring us $5 million right now. And over the next 3 years, we're doing a seller carryback and they're going to pay us over time. The problem with that is when you do an exchange, everything that comes in the 180 days, because you just sold for $20 million, but you only got 5 million in, and in the next 180 days, you're only going to probably maybe have 500 and, I don't know, maybe 600, maybe, sorry, 5 million in, maybe you might have 5.5 mil in, but at the 180 days, that is the only thing that actually gets to be exchanged. But because you're going to exchange, you have to exchange for $20 million. And then every payment you get after that, outside that 6 months, is going to be part of that tax. So let's say you purchase something for 20 mil and you put 5.5 down, but you do the seller carryback. So you're going to be taxed on $14.5 million on your next tax because you didn't qualify for the rest of that money and you didn't exchange the rest of that money. So then you're going to get hit with that. So pretty much every seller carryback payment is going to go to pay your taxes. So that's kind of walks through some of this that you'll get. Funds to note after closing, that's different things with the seller carryback. Exclusion note, 1031 exchange, again, part of all of this. So then this is kind of the deal room that you'll be able to look through after this. But ultimately, our goal with what we can do and help with, strategize, become a resource is that I share my personal cell phone with everyone and take a ton of calls every day. Just people ask me questions because my goal is to help and enable the people to save money. So I'm gonna stop sharing so I can talk, but remove spotlight. There we go. There you go. So ultimately, yeah. So what happens is we become more of a resource and a place that people can find a little bit of safety and security in, because we work like with our clients and with agents and brokers to be able to do stuff within this. There's created an ecosystem within our real estate business, and it's all revolved around 1031 exchange. And something that I did notice is that a lot of times people say, well, we need a QI, qualified intermediary for an exchange, and kind of put us in place with a escrow officer or a title officer. But ultimately, I would say most of the time, when you go with companies that are tied to big title companies own exchange companies, and escrow companies own exchange companies, but those are usually college interns that are pushing the papers, and they can't speak about any advice. They can't work with their clients through any kind of strategy. And when we sit in the position we are, it's kind of really interesting, because I was like, well, with our experience, because I was a developer and traded properties and no finance and kind of worked through all this stuff, that I felt more of a resource to be like, well, we can do all this because we are a boutique national company. And it's been like really nice to help. And so, I have clients that keep coming, my clients do exchanges with me, every few months that have multiple properties, because they, we take care of them. But I'm here to answer any questions and walk through anything else. And I can't wait to, assist with anything you need next.
Perfect. Thanks, Mark. So that leads us into our Q&A. So feel free to either just, open up, unmute yourself and make this interactive. Take this moment to really leverage Mark's expertise and ask any questions you may have.
I will ask one while everyone is thinking about it. Are there any situations that you have seen, Mark, that trying to do a 1031 exchange might inadvertently trigger depreciation or recapture in addition to capital gain taxes?
No, as long as you do a 1031 exchange, you excuse me, swallowed water. As long as you do a 1031 exchange, you completely sidestep any taxes. And I always tell my clients, look, my job is to make sure that my clients don't pay taxes unless they want to. And I've never met a client that wanted to. So yeah, no. And that is actually a question I get from a lot of clients. They go, well, I'm gonna get not pay my capital gains, but are they gonna get me for depreciation? And so no, depreciation is also part of those taxes that come into line with federal. And so no, you don't have to pay anything. And again, it is a crazy law because it's based on intent. So, you know, no matter what you really want to do, as long as you say in your emails and texts that your goal is to buy something and rent it because you want to sit on it for the next 10 years or whatever, as long as your intent is that, and then something happens, or, you know, then, but ultimately it's when you sit across from the auditor, then, you know, you have to, your honest answers have to be a reason, but they will never pin you for the purpose of changing your intent. But if your intent was to flip something and be like, oh, well, we're going to flip this, and then let's get this done, let's get it on the market, and they're like, we'll exchange it, we'll just tell them we did this. But, you know, I mean, I one of my friends that works in the Midwest, and his other friend had an exchange company, and they had a client that had their they had a rental property, but they sold it in like a year and a half, and they got pinged because they only got pinged because he's offsetting, like he owns other properties, but he pretty much underwrites himself like crazy, so he never pays taxes. And then he's like, no, it was a rental property, and they go, so you have 200 Uber receipts from this address with your name on it? It's like, so, you know, it's like, well, why would you be having Ubers taking you and leaving from 200 times? Like, so, you know, obviously he was skirting it, but it, you know, that's it. But no taxes if you do a 1031 exchange.
So, Mark, just real quick too, some of the things that, for those of us that are syndicators in the audience here or they're brokers, how can we better position ourselves to serve our clients who are potential 1031 exchange candidates, right? Because as you know, it's a pretty nuanced structure, and especially we decide that we want to take in investors through a 1031, we have to set it up as a tick structure. So what is your advice as to how what are things that we should be mindful of so that we don't, end up causing an issue of where now they are disqualified from doing the exchange?
Well, okay, so there's actually two questions in there. So I would say the first side that I heard was more like, how do we, talk to people that might want to sell, but are just kind of on the fence? And I think that kind of refers back to what I said before was, hey, how long have you owned this property? Are you under market rent value? Like, are you not getting, you're under market rents and you're paying on debt that you're overpaying for at this price. So, you can sell this, and then let's say you sell for 2 million, but you only have 300,000 or 400,000 in debt, but you're under your market rents, and you want to, hey, I can give you passive income for a tick investment through syndication. And instead of going, and some people, well, I don't want to sell yet. Can't sell because my credit's not what it used to be. I don't have real income, so I can't get a loan to go buy something. And I can't get a $400,000 loan right now to go buy another $2 million property. So one of the parts about this is for syndicators and tick investments is that there's debt replacement. So ultimately they'll sell for 2 million, and they'll pay off their $400,000 loan. They'll get 1.6, and they'll roll their 1.6 into the tick investment. But ultimately the syndicator will slice off the 400,000 as debt replacement. Now it's off balance sheet debt, and it's non-recourse to the party that's coming in, but it shows the government that, let's say they have a big property and they have $5 million of debt, and so they'll slice $400,000 and say, oh, this will cover their $400,000. And so one thing for going into syndications is that ultimately the client that's coming in doesn't have to worry about debt. Now they'll carry that debt through. So if they sell off, like whatever debt decreased over time will also decrease theirs. So if they hold it with you for 5 years, then ultimately maybe they have $300,000 worth of debt, but they have not a 1.6. Now they have $1 million. So they'll get their 1.6 back, plus they make, let's say 600,000. Now they walk in with 2.2, and now they only carry 300,000 in debt, but they don't have to worry about debt when they go into syndications because of the off-balance sheet debt and the non-recourse. So it's never, they're not liable for it, but ultimately they are able to be covered. And then you're saying, look, you don't make enough and you pay too much on your debt. I'll cover your debt and I'll give you passive income at a higher percent of what you get. And now all of a sudden you're like, wow. And do you really want to take those calls to deal with the 3 T's, the toilets, tenants, and trash? So that's that. And then to any snags, there are no snags if you do so I've never seen snags because we've never had an issue since 2008 with any of our clients going into syndications, going to anything, because we step in early on with clients and just walk through, make sure that, the trust is correct and that their LLC is in partnerships, no one's bouncing off. Because ultimately people only hit snags because they do something on their own without, telling people. So we'll give the advice and, I will do an exchange. I'll say, you might get caught for this, but I need it in writing saying you still want to do this, but I usually talk them out of it and never had an issue. So there's no snags as long as it's in place within 180 days.
So just to wrap this up in that sense, one last question as to um, for Mark's information, we'll also send it out to you guys as well. Or actually, while I'm talking here, Carla, if you don't mind reposting Mark's information. And the other thing is, Marc, if you can share with us real quick, if a syndicator is, going through a raise or whatever the case, when is the most opportune time to engage you in the process?
Yep. So the opportune time to engage me is if a client has a property on the market, then that's when I'm engaged. Then what would happen is as soon as it's goes under contract, that's when we need to step in. So people sometimes don't call me till a week before they close, and it's a fire basically. It gets done, but ultimately the goal, especially with syndicators or it doesn't matter what's on the up leg. The idea is as soon as something goes on the market and you want to exchange, then I need a phone call, because my goal is, if you're a broker, I will tell you, you'll say, hey, my client wants to do this, can you get on the phone with them? And I'll say, no, what I'd like is I build partnerships. So as a broker, I would say, hey, look, can you please I have a conference line. Can you please set up a call for you, your client, and me, and we'll just talk it through, because I want to be part of your team by helping. And so then once it's on market, then we'll talk through what's getting sold, where you want to go next. And then I'll share with you all the information. And then the second that it goes under contract, then I need to then have that information and open the exchange, because we need to be in touch with escrow immediately as soon as the contract opens. Because if we get in touch with them even 2 weeks after it opens, escrow then has to change their documents, and they don't like to do that. So the smoothest transition is us being in place before it goes under contract, so that I have everything teed up. So when it does, then we're immediately with escrow, so they have the proper information and it runs smooth. Because most of the time, the only snags I've ever seen is dealing with escrow and certain paperwork not being correct or in place. So that's where we always need to be there kind of with them or first, to make sure that we have everything tied up and teed up.
So bottom line, it's really important that if you guys ever run into the situation and you're not sure when, just give Mark a call, and he'll give you a good guidance of process and how long and timeline and everything like that. So when in doubt, just question the QI. Scott,
Yeah,
you have a question?
I kept trying to say something, but every time I had a question, Mark, he kept answering it. And I'm like, all right, well, I'll think of another one. Then you're like wrapping it up, and I'm like, hold on, I still got a question.
Yeah, it will hit me with it, because I have a good point to what she just said, maybe to answer your next question, but
Well, you do that first. I still got my question, and
yeah,
you'll probably
so
answer.
Well, maybe not, but what I was going to say is that what I do tell people that are unsure. So for investors or brokers, that when you're selling and you're not sure if you want to do what's next, that what I always tell clients, I say, hey, even if you don't know if you want to purchase something or you want to cash out or you want to go to a syndicator, is that it's going to cost you $695 to do an exchange, and you can just drop your money into the exchange away from the government while you take time. So a lot of people freak out because they go, I'm closing in 2 weeks. I don't know what to do. What should I do? I go, oh. I was like, just set up your exchange, because if you don't want to do it, you can always cancel it in a couple weeks after you open it and get your money out. No big deal. But it's better to just open the exchange, or you tell your clients, don't worry, let's just open the exchange. It'll cost you $695 to save $500,000 in taxes or more. And then you just let it sit there while you figure it out and just breathe and take time, because I deal with people's money. That's why I give everyone my personal cell phone. And I was literally on a call last night at Sunday evening at 7:30 and they're like, I can't believe you answered. And I go, and he goes, every other company I work for, I have to leave messages and talk to secretaries and maybe get a call back. And I go, no, but we hold your money, so you should be able to get in touch with me anytime. But ultimately, I always tell people, just open the exchange, let it sit, and just take a deep breath, work through your numbers. And then, hey, if it works out, it works out. If it doesn't, it doesn't. Easy. So what's your question?
Man, you almost answered it.
There you go.
So on the same frame. So one of the things we have over at Freeman Lund is we have a sell side advisory. So people have liquidity events, they're selling a business. A lot of the time there's real estate involved. And what happens is they have that same emotional response when they're selling their real estate. That's not enough time. What do I do? And then they talk to their private banker or their wealth advisor, and they go, put it in a DST.
Yeah, I know.
And so they put it in a DST. So let's say somebody does that, they take $3 million, throw it in a DST. Can they then move that back into a 1031 exchange later?
They can, but they're locked in for 10 years and they
Okay.
can't touch it. They can't get out of it. And so the other thing too is the DST. One thing I'll tell you is every single investment banker will sell you a DST because they get commissions on that.
So then how about this? Let's say somebody put it into a DST years ago and you're out there raising capital for a transaction, and they're like, hey, 10 years ago, I put this in a DST, but I really want to do something different right now. Is that something that should be in the back of their mind to ask?
Yeah, well, no, I mean, all you need to do is ask for their contract and just see their timelines, because there's a timeline on that, and they're gonna. And the thing is that they're not making enough on their money. And they're also not making a huge profit rip on the outside of it. So depending on what they're invested into, is that they're like, they're probably making anywhere from 4 to 5%, but their upswing to the ending of it isn't going to give them the same return as a tenant in common syndication. And Tiffany will tell you, like, when you do a tenant in common, you own this property, so your appreciation grows with the operator. And the operator is just as equal. I mean, obviously there's different investment sides to it, but ultimately everyone makes their share of the profit. And usually it's preferred returns for the tenant in common or investors. So, the operators usually always put their investors first, but DSTs, I mean, you're talking about Kingsmart and these huge companies that they're just trying to fill their buckets, and the guys selling it are just trying to get their commissions. And so one of the things why we are so personable, and I know Tiffany is as well, is that, look, we do business because I want to have clients and do business with these agents for the next 30 years. And the thing about what we do is, again, I don't even know if I added it, but because we help find your up leg and help sell your deal, I don't take a commission or referral rates for helping agents do their parts. We don't take commissions in bringing anyone doing anything, really. My goal is to strategize and help families grow their portfolio. But it's tough because a lot of people that sell these DSTs, I mean, they just want that commission check to take their girlfriend to Hawaii or something, but ultimately you're passed on. And the other thing too is, as far as being an agent or investor, if you're an agent or a broker, that you know, you lead people to DSTs, then you're not going to see your client again. 10 years later, maybe, but ultimately, like, building clients and that reputation is strategizing to better them and build what they want to do, because ultimately that's how we become a team with not just clients but brokers and stuff. So I think for DSTs, you need to see their contracts and when they get out, and then you can strategize what's going to happen after.
Awesome. Yeah, I think that's a good thing to keep, although it's not going to show up as much. But if you're out there capital raising, that might be a question to ask. If somebody says, no, I put it in a DST, it might be another touch point to talk to them
Yeah.
about.
And Scott, I get calls from guys that do capital raise. I mean, there's guys in town. I mean, I get calls from capital raise guys all the times with their clients, because I'm a good resource because I'm unbiased. Obviously, I, I build trust with you guys, but really it's like, use me as a resource to help bring a truth to like the real situation of what taxes and exchanging and building the portfolio. Because really, when you're capital raising, I mean, your investors, you want to keep them for the next 30 years, or their beneficiaries, because you take care of them. So I get calls all the time from people like, Mark, will you jump on a call with my client and just talk them through this because they're unsure about X, Y, and Z. And I'll
I
just
can
tell them,
attest to that. Mark is very accessible for sure. But for interest of time, let's wrap this up real quick. And of course, you know, you guys have Mark's contact information. If you want to reach out to him, to lean in on any kind of questions you may have, feel free to do so. I do have on the thank you again, Mark. That was amazing. That was such great information. And I know 1031 exchange is not it's not an easy topic. There's a lot of nuances. There's a lot of processes that you have to have an expert like Mark to be able to really have a seamless transition. Because just any little bit of goof up can cause a client a lot of money. And so
sorry, I don't interrupt. I'm gonna put in my, you gave the office number, so I'm gonna put in my cell phone number.
okay,
There's,
perfect.
so it's 249. So yeah, let me just do this.
So in the meantime, while you're doing that, I have here our investor priority list. Feel free to, you know, if you guys are interested in signing up to be the first one notified if we have potential opportunities that come up and that you're interested in investing, feel free to check us out. Here is also our QR codes for both myself and Carla. But letting you guys know, hopefully this webinar, you know, we try to do it every month, at every fourth Thursday of the month. It's just that today is Monday because we had a conflicting schedule on Thursday. I believe, Mark, it's your wife's birthday, so we were like, okay, we want to make sure that you got to be there for your wife. But
Yeah.
otherwise, we do carry this on a monthly basis on the fourth Thursday of every month. Next topic, we're hoping to be able to get a self-directed IRA topic, but we're open for any feedback. At the end of this webinar, there is going to be a post webinar that pops up, the survey that pops up. We highly encourage you guys to take it. This is the only way we know how to improve ourselves and what other topics that might be of interest for you to continue to bring value for you. So please just take 1 minute. It's all it takes for you to complete the survey.
And
But other than that, thank you guys.
one thing I would add really quick, Tiffany, would after this is over, would you mind setting up or sending out like an group email with emails and stuff, so I can get in touch with the people that came?
Absolutely. I can forward you the registrant's information so then you can follow up with them and that way you can also forward out the PDF presentation as well.
I want to forward the PDF and then the other white pages that have like other details and stuff that you can good resource that you can also send to clients and stuff that have questions. But then the presentation would be good information for you.
Awesome. And for those of you that are on the call, go ahead and if you open up the chat to save the chat version so you can get Mark's information as well. There's the upper right-hand corner. There you see 3 dots. Go ahead and click on that. You can save the chat and download it.
Nice.
That's one way to do it. Or you can just do a snippet and just capture that. So either way, thank you again, everybody. Thank you for showing up. We look forward to seeing you guys next month. We'll just look out for our communication for the next registration link, okay?
Awesome.
Perfect.
Thank you very
Thanks,
much
Mark.
for having me, everybody. I appreciate your time.
Bye. Thank you.
you.
Bye.